If you could make donations where you maximize your tax deduction but still keep control over that money? Sound too good to be true? That's what we're going to talk about on today's episode of Friends Talk Financial Planning. Hi, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
And I'm Bridget Sullivan-Mermel. I've got a family financial planning practice in Chicago, Illinois. Before we start talking about donor advised funds, we just want to remind people to subscribe. It helps us with YouTube. Okay,
That's
John.
right.
So let's dig into it. So can you just describe what the heck a donor advised fund is? And then we'll get more into the topics about why somebody might want one.
Yeah, that's great. It's funny, the introduction, give money away and keep control, sounds too good to be true, right? And usually those things are, but exactly what you mentioned, Bridget, there's a thing called a donor advised fund that can help accomplish both those things, right? And so we'll talk about, what it is, how it works, and where somebody might want to use it. When I describe it to clients, I call it it's like a mini foundation, a private foundation. If you're, super rich, the Rockefellers, right? Those have a foundation. They give money away from their family. Similar process, but without all the red tape and the requirements and all the costs that go along with that. So in real simple terms, it's like a mini foundation. And what it means is that as any individual, and it's like regular people can put money into this account called a donor advised fund. That account is like a separate charity. You put your own name on these accounts, and you have them at the local community foundation. We do them at Schwab for our clients. I'm sure you do too. Fidelity, Vanguard, they've got these. So we set up an account. My wife and I have one. It's called the Shear Family Charitable Fund or something similar to that. So we donate money into that fund. It's like our little mini foundation. We get the tax deduction when we put money into the Sheer Charitable Fund, right? Putting into our donor advised fund. That's when we get the tax deduction. Then the money sits in there and it'll grow. It gets invested. And we make donations to charity then from this donor advised fund. We give money to United Way and to the church and to, Cancer Society and those things from the donor advised fund. So big picture, it's like a mini foundation, very low cost, very low administrative hassles, easy to use, and it's a place where like regular people can give money away, not unlike the Rockefellers and the rich folks do.
So there's one thing I want to bring up with this, and that is about itemizing. So if you don't itemize on your taxes, so you're not able to take a charitable contribution anyway, is a donor advised fund for you?
Yeah, no, that's a great question. So here's the answer to that is that my answer, and I'll be interested to hear your answer to it, is if the tax deduction isn't an issue, then that doesn't make any difference necessarily. If I'm giving $1,000 a year or $2,000 a year to charity and I'm not getting a tax deduction for it, the donor advised fund, all the things we'll talk about why it can work in this foundation still apply. There is one area where, listen, we might want to give more money to the donor advised fund in a given year. We'll talk about that. We can get into some details. Maybe that's a whole separate episode on some of the nuances of things. But there might be reasons why, listen, we might give a couple, 3 years of charitable donations in 1 year to take that tax deduction. And I guess for me, that sort of lends into, all right, so it's this mini foundation. That's great. Why would I use it? And the one big place that we see where clients take advantage of this donor advised fund is to control the timing of the tax deduction, right? And what I mean by that is when we've got a particularly high year of income, and I know that next year or some point down the road, we're going to have a low tax year. We've got a client that had sold a building that had a lot of capital gains in it. Their tax bracket goes way up just this year. Next year, the year forward, we know that their tax bracket is going to be much lower because this is a big investment that they sold. We can take the tax deduction this year and say, listen, if they were giving $2,000 a year to their church or to United Way or to charity, go, geez, we're going to do that every year for the next 10 years. Why don't we take that $20,000 of donations and take the tax deduction today at 35 or 40% or whatever it is, because that donation in 5 years is only going to save 10 or 20% in taxes, right? So controlling the timing of the donation in those high years.
So I do want to talk about one element about the control is that while you do control the timing of your tax deduction, you then have to give the money to charity. So you
Yeah,
can
yeah.
take the money back. It's not yours anymore. It's in this charitable fund. And so you can't say, oh, I need the money, I'm taking it back. So
Yeah.
you do lose control from that perspective.
Yeah, no, it's a great tool, but it's only money that you are already going to donate to charity, right? It's not, oh, geez, it's free. I control where it goes ultimately to which charity and at what point in time it
Right.
goes there. But it is, you are giving this money away. I'm glad you brought that up. This is that, right? I don't own this money anymore. I still control where it goes, what charity it goes to, but I don't own that anymore. And that in my case, the sheer charitable fund is the charity, right? We make money, that is the charity. Then when that fund doles the money out to the different places, that's not a tax deductible event because it's from charity to charity, sort of a thing.
Right. So I wanted to talk about where I see it the most in my practice, and that is when people get paid through stock at their company. So get restricted stock units, or that for whatever reason they're getting paid through stock, or they buy stock through an employee purchase plan. So and especially if that stock has gone up. So I have some, Chicago's got the good fortune of having some companies that have done really well over the years, right? So if that stock has gone up, then how much they paid for it, there's a big gap between how much they paid for it and what it's worth now. And if they were to sell the stock, they're going to pay capital gains on that. And with a donor advised fund, if they donate the stock to their donor advised fund, they get the tax deduction at the fair market value, and they don't pay capital gains on it. So it's a great planning tool for us. That's one of the things that we do every year with clients is like, okay, how much are we putting in this year? And again, in conjunction with what's your tax bracket looking like? And what do we think your tax bracket's going to be in the future?
Yeah. Yeah. No, I love that. And I don't see as many people where they've got, the company stock things that going up, but just in general, right? I put $1,000 into Apple or whatever the stock is, and that sucker has soared and now it's worth $10,000. Right. And I think you had a blurb or a graphic from a charitable fund. We'll maybe pull that up and put it in the notes or put it on the screen here so people can see that. By giving that money that I could sell that stock, pay the capital gains taxes and give it to charity, or I could just give the stock to charity, right? I don't pay any taxes. The charity gets the full deduction, and we're basically cutting Uncle Sam out of the picture on things, right? We're taking advantage. That's the place where I see it also is we've got timing of the deductions. Geez, when do I want to take the deduction? But then I've got a stock that's gone up, or mutual funds that have gone up, or an investment that's gone up. And one of the things we look at on people's tax returns when new clients come in or prospective clients come in is, are they giving money to charity? Do we see that on Schedule A if they're itemizing? And do they have capital gains, meaning they've got stock that's gone up in some fashion? You go, listen, if we're paying taxes on capital gains and we're giving money to charity, we got to connect those two dots and go, does it make sense to do this through giving appreciated stock or mutual funds that have gone up to charity? Right.
Exactly. And the thing is that you can give appreciated stock to charity anyway. If
Yeah.
you have a charity you want to give to, and you can call them and say, hey, do you take appreciated stock? If they don't even have to be a large charity. They
Like
can be
almost
pretty
any
small.
charity. Yeah.
Yeah, they'll take it. You can get a deduction of 501(c). However, when I've had clients that have actually done that, between wherever usually that's not a Schwab, and it's like some old mutual fund company they had, and it takes work. And with the donor advised funds, once you set it up, it makes it really streamlined, and that's what we like about. And we can help clients with it too. So that's one of the things I like about donor advised funds, is it makes it very streamlined to donate appreciated stock to charity.
Yeah, and I love that idea of, and I'm glad you brought this up. Like, listen, if you're going to give a few $1,000s to charity, you don't need to do it through a donor advised fund, right? Still give the appreciated stock and give that to the Church of United Way or whatever. But here's a situation we have quite a bit is, a lot of our clients don't give $1,000 or $5,000 to one charity in a year. It's $250 here and $500 there and $100 there, and there might be 20 different charities. And so listen, if I want to give some of my investments that have gone up to charity, I can do that. But do I want to do it in 15 different times? Or I do it once to my donor advised fund, and then writing a check from the donor advised fund, you go online. I mean, we use Schwab, right? I mean, it's really simple. You go on and a couple of clicks, you are able to send the money to the charities, and it reminds me anyway, personally, oh, what are the charities I gave to last year? Oh, that's right. I haven't given to, this charity in a couple of years. I need to support them again. It's all sort of the history is there. It's really slick. I did want to bring up before we wrap up, what are the downsides? Why wouldn't you use a donor advised fund? And in my experience, there's very limited. There's not a lot of downsides, but there is one that has come up I want viewers to be aware of is if you have a company matching plan, and you mentioned some of the larger companies down in your area, is we've got some around here where, listen, I give money to charity, maybe my company will match up to $100, $500, $1,000, and that's a great way to double my giving. We've had some instances where we've had clients that had that company matching for charity, but when the money went from the client into their donor advised fund, the company said, well, that's not really the end charity, so we don't match that. And then went from the donor advised fund to United Way or whatever the charity is, it wasn't a taxable donation and so the company didn't quite know how to match those donations. So that's the one place where we've seen where, other than that, we haven't had any glitches other than, hey, if your company matches, you might want to check with them before you fund a donor advised fund, just to make sure you're getting your goals accomplished with things.
Yeah, and the other thing I want to say is that we're going to do another episode on this as well, and we're going to talk about some more advanced strategies like bunching and involving your kids. So tune into our next episode or our upcoming episode for even more experience and strategies about donor advised funds. So with that, I'm Bridget Sullivan-Mermel. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. Both Bridget and I are taking on new clients, so if you're interested, we'd love to hear from you. But we're also both members of the Alliance of Comprehensive Planners. And if you like what you hear on our show and want to talk with a planner who thinks similar to how we do in your area, you can check out acplanners.org.
Don't forget to subscribe.